Good afternoon, a warm welcome to you all. My name is Pieter Schlosser and I work for the Florence School of Banking and Finance. I have the immense privilege to introduce and moderate this online seminar. And today I'm in the company of Daniel Gros and Willem Pieter de Groen, both working at CEPS. Welcome to both of you in Brussels. Many thanks for being with us today. Before introducing the topic of today's seminar, I'd like to tell you a bit more about our school, as we have several activities in the pipeline that will be of interest to you. The Florence School of Banking and Finance is a program of the European University Institute, which, as you may know, is a postgraduate public and international research and education institute located in Florence, Italy. The EUI offers PhD programs in social sciences since 1972, and more recently is also providing executive education courses to practitioners. The FBF, the Florence School of Banking and Finances, focuses precisely on executive education and is a place of debate, of learning, and of exchange, a place where the new and the more old generation meets to discuss and argue about cutting-edge topics of financial stability, risk management, as well as recent issues of banking regulation, supervision, and not least, banking resolution. All this for Europe's common good. In this spirit, we will have our annual conference next week in cooperation with our partners, Imperial College London and Bocconi University. The conference will focus this year on institutions and the crisis, and the conference papers will be, like every year, published in our Blue Book, also available on our website. Last but not least, our next online seminar will take place on the 2nd of May on the European Monetary Fund, together with Rolf Strauch from the ESM and Marcello Missori from CEPS, from SEP, which means the School of European Political Economy, based in Rome at Lewis. In terms of training, so far our school has trained more than 1,200 professionals. They're mostly active in central banks and banking supervisors. We have several residential courses coming up next, which should be of interest to you. In May, we will host the course on bank regulation for supervisory purposes and on measuring volatility and risk. That's a separate course which will be later in May in Barcelona. In late June, we will look at credit risk and market risk evaluation, and we're in the process, of course, of designing the courses that will be held after the summer. So please stay in touch. Let me move now over to you. You, the audience, you are around 145 participants connected today, following us from everywhere in Europe and to some extent the world. 36 nationalities are represented. We have many people from several national central banks, as well as from the ECB and the Commission, but today it's the Single Resolution Board, also based in Brussels, which is the most represented organization. In terms of gender, we have 45% of women and 55% of men. And when we look at the professional experience, you have about 7 years of professional experience on average. Most of you are trained economists. That's not much of a surprise, but we also have lawyers and business backgrounds with us. Lastly, most of you have a master's degree, while 25% of you have a PhD. Right, so the topic of today's online seminar is risk reduction in the banking union. We will engage with two different but related discussions today. On the first side, how to deal with non-performing loans, known for experts as NPLs, and on the other hand, how to treat and how to deal with sovereign debt concentration. Daniel and Willem Pieter will therefore share their analysis and, if I may say, wisdom today on these issues for about 15 to 20 minutes. Then we'll open up for the question and answers session, where you guys sitting in front of your computer, wherever you are in Europe, will step in and ask your questions or provide your analysis and comments. Let me stop here and leave the floor to Daniel and Willem Pieter.
Many thanks, Pierre. It's a pleasure to give this presentation. I should warn people perhaps that I'm not a banking expert. I'm more a macroeconomist. And I prefer to have a banking system which doesn't give me problems. But this has not been exactly the case over the last years. And I must also admit that most of what I know about banking I have learned from my colleagues here, Willem and Karl, whom you're not seeing. And I also realized that the 57 people who have logged in from about 100 meters from our place here in Brussels at the Single Resolution Board, they probably know much more about the details of banking regulation than I could ever dream to acquire. But let me try, nevertheless, to discuss these two issues in a broader, perhaps a macro perspective. And the background is, as you can imagine, the current discussions about deepening the banking union as one key step in reforming the euro area governance more generally. And the spoken and unspoken, but mostly now spoken and written condition for advancing on that is that we should have first some risk reduction before we can put some risk together. And the two biggest obstacles which are being mentioned are, as you said, non-performing loans, NPLs for short, and the concentration of sovereign debt on the balance sheet of the banks. And the first general warning I want to make is that these are very different in nature if you look at these two issues. And what Willem and I found was that NPLs are much more country specific than the sovereign debt holdings. That our view would be that the NPL problem is manageable. And that the sovereign debt is very much concentrated in particular banks. So it's just not just the general problem, but it is a very problem which is sometimes very specific to specific banks. So this is, if you want, the bird's eye view that we have acquired of these two problem areas. And now I would like to go to the first one, which is NPLs. And the first point is, of course, NPLs are bad for a bank, right? They mean a loss. But the question is, how big is the problem? The nominal amount of all exposures which might create a problem for the entire EU is big, is 1,000 billion. I would just warn you that for the sample of banks for which actually we have data, it is quote unquote only around 700 billion, right? But that's actually not the interesting number. The interesting number is much more how much remains at risk. And there we will just give you some numbers. And the second point then is to question is that we would like to put on the table is if there is a remaining risk, how should it be dealt with? Can one force the banks to recognize the risk, and what are the implications of that? Is it a danger for the stability of the system, or is it, as I would argue, more loss of control for existing shareholders? And if you look at it this way, then this is my last bullet point there, I would propose to look at the problem not in terms of overall numbers, but in terms of the own funds, because it gives you a rough idea of how much additional capital banks might need to deal with any remaining problems. So let us give you some numbers which Willem put together. This is first of all the ratio of non-performing exposures and forbearance, which is not a major part, as you can see there, in systemic euro area banks. Most of the data that we're going to show you is from a sample of the systemic euro area banks for which we have the data from the EBA. So it is about 70–75% of the euro area's banking system, as you know, with an uneven geographical coverage, but I think it is still broadly representative of the wider problem, and certainly representative of the banks which are under the direct supervision of the SSM, and therefore, let's say, the banks for which, in a certain sense, it's not quite correct to say, but in a certain sense, the risk sharing is the biggest. So what you can see is that, and let me say also that most of the graphs which I will be showing now would be for the six largest banks. Countries. Because if we were to show you Cyprus or Greece, of course, it would be off the charts, but I don't think that is representative for the euro area. So that's why we have looked at these six countries. And you see that clearly the biggest problem is in the countries which have suffered from the crisis, Italy and Spain. But even for France, if you look at the non-performing exposures, they're still equivalent to about 1/2 of the own funds of the banks of the country. I realize, of course, it's an average for the country, but the variance across banks is not as large as the one which I will show you later for the sovereign exposure. So that is, if you were to say, okay, that is the nominal amount, which is, so to speak, at risk. But of course, banks have already put provisions against that. And therefore, one should look at the next slide, which gives you the non-performing exposures, minus already what the banks have put aside for impairments and provisions. And then you see that the problem still remains substantial, with the remaining amount at risk, 50% of own funds for over 50% for Italy, for Spain, and again something also for the other countries. So not insignificant, but not as overwhelming as it appears at first sight. So this number, the 55% of own funds for Italy, gives you the answer to the theoretical question. Assume the residual value of all these non-performing exposures were 0. By how much would the Italian banks have to increase their own funds in order to have the same ratios as before? Right? And that the answer then would be it's about 55%. So it would have to be a huge amount of increase in bank capital in Italy. However, these exposures are not worthless usually, and therefore Willem and I did a simple calculation. If you can go to the next slide, please. Not yet. Go one back. So you have a problem which is partially provisioned, but then you could ask the question: what if we just assume that the residual value of all the remaining exposures is 20% of the nominal, right? And then the question is, how much is the remaining loss, so to speak, to be covered? And then here I've already mentioned, then actually if you are somebody who says we can have common deposit insurance only after the NPL problem has been solved, then actually next question would be, is that actually the residual problem, could it be covered by the bail-in capital, which should be 8% of total assets, liabilities minus, what is it, minus?
Liabilities plus own funds.
Plus own funds, right? And that actually would be covered. But let me just give you now the data where we assume that 20% would be residual value. And I must say, to my surprise, this is not that much different from the values which I had shown you beforehand. So for Italy, even if you were assuming that the residual value of all non-performing exposures is 20% of the nominal, then you would still need an increase in capital of about 35%. For the Netherlands, still 1/20th, Belgium, Germany, and so on. So this would be the overall need. And of course, if you go to the next slide, there's immense resistance to have this loss recognition. And I wanted to ask whether that resistance is justified. Now, there are two ways you can force a loss recognition. The first one is to say, banks, you have to sell these NPLs, you have to get off your balance sheet. And then the banks will say, of course, this is likely to be below the true value. The market value is below the true value, because these NPLs have a typical lemon problem. The Akaloof, I presume you know the Akaloof model. If you sell an NPL, then somebody who wants to buy it will say, probably the bank will say the worst ones first, and therefore I give it a low value. If that were the case, then what would happen is, of course, current shareholders would shoulder the losses. But it would also be true that actually they should have bought these NPLs. If current shareholders believe that these NPLs will be sold at too low a price, they could just have said, okay, if they're being sold, I just buy them myself via some special vehicle, and that way they could have avoided the losses. The other way to force banks to recognize potential additional losses is by allowing them to keep these non-performing exposures on their balance sheet, but to tell them they must be written down to the residual value which we assume, let's say the 20% which I have. And then the banks just have to get new capital for the amount of the losses that have been recognized. And again, if the supervisors is too tough and the loss is in the end actually much less than assumed, then over time then the banks will write the stuff back and will make higher profits. So the new capital will have a very high return. And again, if the shareholders believe that the supervisors are too tough in assessing a very low value, then they should just participate in the capital increase, and they would get the return over time. So in the end, as I said, the opposition to forcing banks to actually recognize losses either way or getting it out of their balance sheet is difficult to understand. I understand that very often the market price can be wrong, but if the banks themselves know the correct price, then they should put their money where their mouth is. The problem, I think, in Europe is, or especially in some countries, is that many of the shareholders don't have any money, and therefore they can just complain, and they wouldn't be able to increase, to participate in capital increases, and that's why they so much oppose them. So that is, let's say, the microeconomic aspect why the problem is so difficult to deal with. There's this opposition. Now, as you know, I'm much more interested in the macro aspect, which is that should be concerned as a supervisor and as authorities in general about NPLs. After all, as we said earlier, we know them by now. We can calculate how much remains at risk. But is there concern over and above that? And the concern which is most commonly raised is that banks with high NPLs usually give less credit. That is true. The question is whether that is an association or a causation. The association is clear how it can arise. After a credit boom comes the bust, and during the boom the banks give lots of credit, during the bust they give very little credit, and during the bust they also have NPLs. So NPLs and little credit go together, but does one cause the other? That's the question. Most people actually look at the Japanese experience and say, there you see, suddenly the banks don't give credit and the banks have very high rates of NPLs, which they are refusing to recognize. They're evergreening them because at zero interest rate that's easy to do, right? That doesn't have to pay any interest. But if you actually look at the theory of banking, it's not quite clear that a bank which has made losses through NPLs and which has perhaps recognized only part of those losses, or a bank which feels weak, that this bank will give less credit. We know from theoretical literature it could be the opposite. It could be that the weak bank actually gambles for resurrection by being more generous, handing out more credit, or whether it hunkers down. And at the micro level, there is very little NPL, very little evidence that actually banks with higher NPLs give out less credit. And I now realize only now that I have forgot to ask the one question about NPLs, the one.
It has been raised.
It has been raised. Okay, it has been raised in the box. Okay, okay, good. So,
so this is the result.
What were the responses?
Banks with high NPL ratio restrict availability of credit. Yes, 83%.
Okay, good. So that brings me to my simple point. Italy is the one country where you have lots of NPLs, where banks are most burdened with NPLs. So you should see banks restricting credit. And if that has an impact, you should see banks that investment falling. And you might be saying, yes, but we know that investment has been falling in Italy. But I wanted you to look at the next slide, which gives you the difference in the ratio of investment to GDP between Italy and France for two types of investment. One is equipment and one is construction. And what you see in the blue line on the top is that in Italy, the investment rate in equipment is still higher than in France, and it has actually been slightly increasing over the last few years. So, and since most credit investment is financed by banks especially for small and medium-sized enterprises, I would say very little evidence that at least the credit crunch in Italy has affected productive investment in the corporate sector. Whereas what has diminished, but that's trend-wise already for a long time, relative to France, is investment in construction. And of course, construction, the strength of investment in construction and credit to construction depends much more on the strength of the household, of the real estate sector, house prices and so on, than on the availability of credit. So I would say that at least this piece of macro evidence, and I could show you different data for Spain and some other countries where you think there is a credit crunch, that with the exception of extreme cases, of course, like Cyprus and Greece, the evidence that higher NPLs lead to at least less productive investment is not that strong. But I invite you to look much more at the macro evidence. So let me then turn to our second topic, which is sovereign exposure. And that is also something in which the details count for a lot. And I have given you here some of the points which you have to look at especially if you deal with data. First of all, it's not just bonds, it's credit. Secondly, it's general governments, so not just the formal sovereign, but also subnational data. What we find also is that sovereign exposure is very variable across banks, actually more variable across banks, individual banks, than across countries. We did not find, and that we will not show you, just no strong relationship between the business models and sovereign exposure. Because also you find some banks which just specialized in financing subnational governments and agencies. And if you count that among the sovereign exposure, then you have to certainly make special provisions for them. And then I wanted to warn you that when we see data from international banks or banks with cross-border operations, especially via subsidiaries, you might think they are at least partially diversified. So to give you an example, for UniCredit, you might find that 70% of UniCredit exposure is Italy and 30% is Germany. You think, they are diversified. But then this might be because 100% of UniCredit Italy is Italian government debt, and 100% of the subsidiary of UniCredit in Germany is German debt. So when you look at this data, actually, it's very difficult to say whether it tells you anything about the bias enforced perhaps by national supervisors, because everybody says it is, especially in Germany, they say it is clear that an Italian bank, if it has zero capital and zero risk charges against sovereign debt, it will prefer to hold Italian government debt, which yields 2%, instead of good old German government, which has a negative yield. The more difficult question is to answer, why should German banks hold German government debt when they could hold Italian ones, which yields much more, again, zero risk, zero capital charges? I think the only answer one can give is it must be some supervisory pressure. If I can have the next slide. So now I will delude you with some data. So here already you see that across banks, you see the ratio of sovereign exposure relative to the own funds. That's the
frequency in the system.
Yeah, that's a frequency. Yeah, that's a frequency. You see, the vertical line is the frequency in the system. Mm-hmm. You see that there also is a very wide distribution. There, the mode and the average is 200%. So government exposure, and this I repeat, this is more than just bonds, is actually on average around 200% own funds, which means that if it's all domestic exposure and your own domestic sovereign goes belly up, that's about Greece. Then you lose 200% of your own funds, or the banking system is gone, basically. But if you go on, you see also very large variability across countries and banks, in the sense that for Belgium, for example, the domestic exposure is only part of the overall exposure. Whereas for Germany, Italy, and so on, you see that the domestic part is much, much larger compared to the rest. So we already see that the Benelux banks, of course, are, or say not the Benelux, but at least the Belgian banks are more, and the next slide, please, diversified. Here we give you the minimum and the maximum for each country in terms of the government, of the home bias in the bank. So in Germany, you find one bank where the German exposure is a very small part of the overall government exposure. And you find another one bank where the domestic government exposure is 100% of all government exposure. So both extremes. One which, one bank which finances basically local governments only, and another one which must be a large bank which is internationally operating, which has only a very small home bias. And you see the same thing for Belgium, but even for Italy and France, you see a very large variability. Okay, let me perhaps jump over the next slide and then go immediately to the last one on this topic. Yeah, the next one. We also try to look at any change we could identify, which is difficult because the decisions over time change. Even taking into account these definitional changes over time, you see very little change among these large countries, which will show you between 2013 and 17. The home bias remains more or less unchanged. Okay, now let me come to the contentious issue, which is the next one, please. The next one. Okay. Whether actually it is useful to have your meaning your country's own banks buying your own sovereign. And there are two tails, and depending on what point of view, somebody always says, this is the real problem, or the other one says, this is the real problem. One is Greece, where the banks held more than 2 times their own capital in government bonds. Comes the so-called haircut, the voluntary, PSI, private sector involvement, right? And formally, the value of the bonds, the government bonds held by these Greek banks, go to close to zero, not quite 20% of the nominal. And then the Greek banks would have lost several times their capital. But since that is not possible, what happens is the ESM had to loan the Greek government the money to make the banks recapitalize the banks. So basically, you couldn't really cut that particular government debt, because in a systemic crisis, the government owns the banks, or the government and the banks are the same thing. If the Greek banks had been diversified, it would have been easier to cut Greek government debt. There would, of course, have been more losses outside Greece, and maybe the crisis for Greece, at least, might have been more manageable. That is one tale. That is why it is good to have some diversification. For Italy, the argument is, of course, the other way around. The Italy's arguments are it's a very good thing that the banks made profit, bought these BTPs, long-term Italian bonds, at actually distressed prices, and they made a big profit on that. And if they had invested the same in lending to the private sector, they would have made losses. Excellent bargain, very good, stabilized the banking system. And it is on this last part that I wanted to make a question mark by going to the next slide. And there I just show you two things: Greek general government bonds held by the Italian banking system, and the bank bonds issued by Italian banks. And when you go to the next slides, why is that key? Because you need to look at how banks actually finance the purchases of their own government bond, or the bonds of their own government. If they buy medium to long-term government bonds, presumably have to show medium to long-term financing, and that means basically they have to issue bank bonds. And now comes the rub. Normally, the yield or the cost of a bank bond is higher than the yield on a sovereign. Makes sense, right? The bank is a bit more risky than the sovereign, and that means that if you have a banking system or a bank which holds at the same time very large amounts of government bonds and has issued a very large amount of bank bonds, it has a negative carry. And if you go back to the previous slide, then you see that for Italy, the amount of bank bonds outstanding was much larger than the amount of government bonds they had held. So in a hypothetical case, when they had cut their balance sheet by both bank bonds and government bonds, then they would have saved on the carry. The next slide, and the banking system would have actually been more stable. So therefore, we conclude that if you go to the next slide, that if you have the large exposure requirement, which actually would forbid banks to be too much concentrated in their holdings on the domestic government, if you have up there the Greek story, you would reduce the feedback loop. Of course, people say the Italian story is a relevant one, and they would say, no, that's not the case. But I would say maybe you should look at the Greek case, because, as I said earlier, the Italian case maybe is not as positive as the eye would suggest. And the next question, of course, is, and that many people ask, is what would happen if we actually were to introduce a limit on exposures? And here, perhaps I give the floor to Willem, who can explain you the next two slides.
So thank you, Daniel. Looking at these slides, so what we did, we did a short, simple simulation of what would happen if you would impose large exposure requirements, so about 25% of capital maximum exposure to a single group of creditors. In these for the banks that we had in our simple sample of around 76 banks in the euro area. So they hold now about, say, roughly 20% of all the general government debt. About half of that is above the large exposure requirement that is valid for other counterparties. But it's likely that that amount will be reinvested. So looking at that, you see that almost everything can be reinvested in other countries. What we assumed that would be reinvested along the share of the country in question in the total euro area government debt. But this will lead to some issues in smaller countries, so therefore we implemented also a cap on the maximum concentration in smaller countries, and then also that amount would be reinvested again, and then you would see that overall the total amount that these banks could have hold in government debt would decline by around 1%. But what is interesting, of course, is to see how that dribbles down to individual countries. So looking at how much of the debt would be held by banks. And then you see quite some impact across countries. So, for instance, in Belgium, the share of the share of government debt that would be held by banks would go up by almost 8%. So from 24 to 32. So it's about a third increase. A similar development you would see in the Netherlands. So basically, I would say mid-sized countries in terms of public debt. But if you look at the countries with a large total public debt, you would see that the holdings by bank would decrease substantially if the results of the simulation would be true. So I would keep it here because also a matter of time.
Okay, but if I look at your last,
So except for the only exception is a bit Italy, where you see that it's just a fourth decrease in.
So surprisingly for Italy, where there's the biggest fear that forcing banks to have this this limit on exposure, there actually the impact would be the smallest. Okay, that brings us to the end. Just a quick conclusion. So I would say the existing stocks of NPLs should not be viewed as an obstacle to finish the banking union, which anyway would happen gradually. The impact of the existing stock of NPLs on lending policies are a priori unclear. The macroeconomic evidence is not discouraging. We would argue that the home bias in sovereign exposure is likely to actually increase the sovereign bank nexus and instability, and that the story that banks which buy their own government bonds actually strengthen the market is actually not as strong as it appears at first sight. And in terms of what to do, our point of view would be that if one were to force the banks at least a little bit to quicken the pace of loss recognition, and even if it's at times perhaps excessive, I don't think that this is such a big deal because, as I said, they get the money back later if really the stuff is worth more than the supervisors or the market thinks today. And on the home bias and sovereign exposure, my main concern would be that actually governments open different channels so that they can sell their own debt directly to households, because it seems really ridiculous that households have to hold bank deposits which are then invested in government bonds. And that one should implement, especially in good times, a limit on the concentration of government debt on the home sovereign. And if people really believe the Italian story, which I don't, but still, if they do it, then one could have an escape clause for the ECB, which says in times of market turbulence, banks might be able to buy a bit more. Let me conclude here.
Very much. This has been very, very interesting, and I'm sure there will be plenty of questions also on the data in the Q&A. So let me invite all participants to prepare their questions in their mind and with their fingers, let's say. I just had, I mean, to make your recommendations even more specific on the sovereign debt concentration part, if you had 1 minute in the one of the next European Council meetings, 1 minute of attention, what would you exactly recommend? What would be really the specific recommendation you would have to formulate to heads of state and government to do on sovereign debt concentration?
I would say grandfather the existing stock, but put a hard limit on the concentration of any renewals or new acquisitions of sovereign debt, and that you can do in parallel with the deepening of the banking union.
Thanks for that. So Jan just put up in the chat box the results of the 3 polls, which you may want to engage with. And then we have another question by Tim Segbor, which is asking about your view on the home bias in the context of specific business models such as public sector banks.
Yeah, that was the poll apparently said that the buying of home sovereign bonds did stabilize the markets during the crisis, and I know that that's the general perception. But I put up this data on the amount of bank bond financing on purpose to show that actually banks issued additional bonds during the crisis. I presume these were the counterpart of their buying of sovereign bonds, and they had a negative carry on this, because in Italy, for example, during the crisis, the cost of bank bonds was almost 1 full percentage point higher than that of government bonds. So now what Italian banks, of course, did was they stuffed the portfolios of their clients with their own bonds, because on that one they have higher, fees, but they could have just stuffed these portfolios with government bonds.
Then a few new questions coming up. You see them on the chat box, so have a look. There is a question of Katarina Bergant. Would you consider the latest suggestion of the ESRB about ESBs as an alternative solution to sovereign exposure limits? So quite a topical question. And then a question on the banking union helping to control sovereign CDS markets in the euro area. So 2 different aspects here.
Okay, on the first question, if there were a market for SBs, okay, I would be very happy. No, I would buy the junior tranche. I would actually buy the junior tranche, not the
more risky.
I would buy the more risky tranche. But I doubt there are many people like me and I must say, I'm not a very large part of the market. And so I think the SBs should be tried, but I am afraid they won't work. What I would propose, however, is something, if you want, much more marginal, but perhaps important. You see, I would tell banks, we have this exposure limit, but if you hold a portfolio of government bonds, that you can do. And then banks can either put their portfolios together, or, and this would be, we could do it from the regulatory side, we could give private investment funds, bond investment funds, the label diversified. So there exist thousands of different investment funds, right, which you can buy, which buy only euro area government debt, different maturities and so on. And you could say under certain minimum requirements, we classify investments in these funds as diversified. And there's only government debt, so 0 risk. And therefore, we should allow banks to hold them without any capital requirements and without impinging on the large exposure. This would be much less of an intrusion, if you want, would not create new securities, but would just recognize that these investment funds actually do the
So before can we engage with the question of Miguel Angel on the CDS markets?
And I apologize, but I don't understand to control this
Miguel Angel
CDS
to
market.
reformulate
What
and
does that
extend
mean?
this question, and meanwhile we move over to another question, which could be Ana Maria on the period 2011-2012, where she claims that there was a positive carry. Remember that resistance for the central bank to act as lender of last resort led to the LTROs, so the argument holds if you start at time zero. Do you agree or disagree?
What does she mean by 2011-12? There was a positive carry. At that point, bank bonds cost less than government bonds. Now we know that that during until 2010-11, Italian banks had the habit of staffing the deposits of their own clients with their own bank bonds, sometimes even junior bonds, on which they paid very little interest. I mean, actually, the point was not so much that they gave their own clients bank bonds in general, but only the bonds of their own banks. Now, that was clearly not compatible with any whatever banking regulation and consumer protection. So if she means that part, I don't think that is an example one should follow. Normally, a bank pays a higher risk premium than a government, and therefore normally holding government bonds and having bank bonds has a negative.
The monetary policy as well.
Okay.
So that you had the cheaper monetary financing.
The tier, yeah. The LTRO. Yes, that's a different thing. Of course, that's different. That is completely different. She's right there. If the central bank offers the banks medium-term financing, which then they can use to buy medium-term government bonds, that is totally okay with me. But that is something different.
I think that period was really interesting.
But apparently,
I don't know if there was any serious work done on looking at the effect of the LTRO on the doom loop, if there was any, because I think that was an interesting period.
Yeah.
Okay, so shall we look at the question of Cosimo maybe, which is I think looking at the chart on the comparison between investment in Italy and France. The one you presented, Daniel, so I think that question goes to you.
Yeah. Okay. Maybe if you can put it back. This is, of course, only one case. It's not econometrics. So if I see the data correctly, over the last years, in terms of equipment investment, Italy has become a little bit stronger relative to France. Am I wrong? Right? This upper trend. In terms of construction investment, well, it's a little bounce and it goes down trend-wise beforehand. But as I said, yes, for construction investment, it doesn't look good. But I would argue that construction investment in this case was perhaps more demand-driven. And let me perhaps expand on the argument. The argument usually had been that in Italy, what was needed was strengthen the export capacity of Italian industry, and that they were hindered in that by banks being reluctant to grant them credit. Whereas, if you want, the real estate sector we knew it was moribund, but that was not the key problem. I don't show you the data for Spain, but let's say for other countries, typically during a crisis, the problem is how to switch from domestic investment to investment in tradables and exportables. And I think that this switch has not really been hindered in Italy. At least that is what the macro data suggests.
Okay, thank you. We'll go back to the chat box, and there was a question I remember from Jeroen on the actually the idiosyncrasy, if you will, of the local and regional governments when it comes to reducing sovereign debt exposures and concentrations. I mean, how would they be affected by a general new regulation on that?
Yeah, that is a problem for which I don't have a solution, I must say. Technically, of course, it's not sovereign exposure, right? Because the land Baden-Württemberg is not quite sovereign. But it would still be a single exposure because it would be very regionally concentrated. I must admit, as I said, I don't really have a solution for that.
They don't necessarily need to be banks often because they don't take deposits.
Yeah, exactly. If they don't take deposit, then sometimes they're classified as banks. But the only thing, as we all know, is we would like to avoid a situation whereby you have deposits which are which can be run, right, or experience a run on an institution which is A, highly leveraged, and B, has maybe a large exposure, which would then create the fears that the institution might go bankrupt and then trigger a run. And that is what we would like to avoid. It's not so much the sovereign exposure, but any large exposure with a funding base which is runnable.
Okay, thanks. I think we have we'll go a bit over time by 5 minutes, let's say, so we can still gather 2 or 3 questions if that's fine for you. There is a comparative question on the US. Do you think the EU should implement restrictive rules like in the US? I don't know if you're familiar with US regulation on that. If not, there is a question by Ellen on risk weights as to sovereign exposures deriving from the real risks they impose. Would you like to engage with this one?
Yeah, actually, let me first say I think the US experience is actually interesting. As you perhaps know, I've done these comparative pieces, Nevada and Ireland, where one sees how much the existence of a banking union and different aspects of the banking union can actually reduce the risk to the local, not sovereign, but to the local government, right? And that was not just the FDIC, but also the nationwide securitization of mortgages. If we had similar things in Europe, then the Irish and the Spanish problem would have been much easier to be dealt with. And then there's an interesting parallel between Greece and Puerto Rico, which both went belly up and both have a recession, both have actually very similar dismal economic performance. But again, there's one difference. The banks in Puerto Rico do not hold Puerto Rico government debt, at least not significant amounts of that, or of the Puerto Rican local institutions which then went belly up, like the power company and so on. So yes, the FDIC did stabilize the banking system in Puerto Rico, but it didn't have to pay losses for losses which actually occurred because these banks were overly concentrated on Puerto Rico entities. So in that sense, I think the US, not its rules, but the way actually it works is a very interesting example. Sorry, and on the
risk weights versus having large exposure requirements.
I mean, the risk weights tend to become, as you know, pro-cyclical, and they tend to change. I would argue that we have actually large exposure for all kind of exposure, independently of the rating. You don't have a larger exposure limit for AAA rated stuff, right? So, and that's why I would say that I would just make it independent of the rating.
And I think also what is to some extent important with whether to use risk weight or a large exposure. What kind of event are we talking about? Is it an event that has a high probability of happening, but a relatively low loss given default, or is it an event with a low probability and in case a high loss given default? In case of the later a cap, so a large exposure requirement is more appropriate, whereas in the former, most probably risk weights are more appropriate, so that you can really absorb the losses in a way whereas in the case of Greece, for instance, you saw that at once the entire capital of banks was wiped out because a sovereign default is such a low probability but high loss given default event.
Okay, I have since there are no further questions in the Q&A box, I have a sort of grand question that I can't resist asking you. I mean, it's been almost 6 years now that the banking union has been created. What's your general take on the performance of this new construct, and what's actually your forward-looking view on what is going to happen next and what needs to be done to make it fully working? And then we stop.
Okay, question at the end.
Too late.
Yeah.
That is clear. But I think what we have now is pretty robust. A lot will depend on whether we have from time to time at least some banks which go belly up to ensure that people remain on their toes, right? To show that there's a risk in the banking system, and that is difficult to predict. I think for the time being, for the short run, the deposit insurance would be nice to have. For the very long run, I think it is strategic to get the national supervisors off the hook of subsidiaries of other banks. So that's another problem that we have. And if I could have Europe-wide securitization of, let's say, conforming mortgages, I would take that over deposit insurance. I think it would actually be more important. I mean, you know why? I mean, it's obvious, right? Because if you have European-wide securitization and you have losses concentrated in any one country, then the losses are distributed. The worst are what we have is what I call these bonds, covered bonds, right? Because the covered bonds means in the end the bank is still responsible. What's the point, right? We want to have banks which are leveraged intermediaries, which are always at the heart of any crisis. We want to make them as robust as possible, and therefore covered bonds don't allow us to do that.
So more direct intermediation.
Yeah, we want to disintermediate part of the of the systemic risk, okay. Certainly.
Willem, Pieter, closing remarks?
There are a lot of, I think, nitty-gritty things, but I think since today was more on the macro aspect, I would leave it here. I mean, myself, I work a lot on resolution. I think there is still quite a long list of all kinds of refinements, including the work on the of a backstop to the single resolution fund. So let me put this one also in the can of
and there
wishes
will
for the banking
other online seminars to discuss those things. So let's stop here. Let's thank our speakers first to all their efforts and their speeches and engagement today. So thanks a lot, and thank you to the audience, to the participants. The next event that we have online is on the 2nd of May. We will have, as I mentioned, Rolf Trauf from DSM, who will talk about the European Monetary Fund, and we'll look at what the contribution of this new design ID basically is going to be, or is expected to be.